So thank you. Today's topic is profiting from conditional order. Maybe you know what conditional order is. It's also called activation rule in TradeStation, and in some platform it's called conditional order. So I'll explain the conditional order and why do we need to use conditional order if we want to, don't have to. So one of the way to sell the close our trade in options based on conditional order. So the conditions could be any. So I'll explain on I give you the example of some conditions and why we need conditional order. So before we go into the conditional order, this is what I read somewhere about the month of February. It says February is the dangerous month to speculate in stocks. So I don't know if you agree or disagree. February is the dangerous month to speculate in stocks. And the other months which are dangerous are July, January, September, April, November, May, March, June, December, August, and October. So yeah, the other 11 months which are dangerous are these. So February is one of the dangerous months, and the other 11 months are listed here. So it's our great grandfather Mark Twain told us. So people, worry about whether the market has bottomed or how long the market will rise, etc. Is it a bear market rally? Is it a bull market rally? Is it a new bull market, etc.? So you need to know what the market is doing from day to day and what you expect in a coming week. So I do that since January 4th, the market is up, as we know. So if we come to know about the market early on, then we can position ourselves towards that direction and keep building the position. So I'm long in like 95% of my positions are long, just one or two puts positions, otherwise all long. This is also, I read somewhere, human are thinking machine. We all know we are thinking machine, but we are human thinking machine. So we are thinking machine, but we are human thinking machine. And here is a question, a little question, which I can give to my daughter. Maybe she will answer correctly, maybe not, I don't know. A bat and ball cost $10. The bat costs $1 more than the ball. So how much does the ball cost? So it's a simple question. A bat and ball cost $10. The bat costs $1 more than the ball. So how much does the ball cost? Maybe you can think while I'm talking. A simple question. I'll give you the answer at the end. We're trying to figure it out. How much does the ball cost? If a bat and ball cost $10 and the bat costs $1 more than the ball. So it's a simple question. Give you the answer at the end. Now back to the trading. Yeah, Mike, I know. So we are human thinking machine. So types of targets. So if you're a member, whether on a trial or on paid basis, we provide you 3 targets. So I provide 3 targets, and there is a reason for providing 3 targets. So the traders can scale in and scale out. So there is another webinar where I explain in detail what we do, how I do it, at various targets, these 3 targets. And once the red target is hit, the 3rd target. So there is another session I explain in detail. So the point is the exit. So how we need to exit. When we are putting the trade, what are the different ways of exiting the trade? So the trade management is very important. We can enter in the trade, but then how to get out and where to get out and what else we are watching the chart or the target, some target we figure it out based on the chart or some kind of objective. So traders have different ways of exiting. I give you example, and I'm sure you will agree. Some say, okay, my target is 40%. When I buy a $10 option, I sell at 1400. So 400 is my target. 40% is my target. Some traders say that I have a $200 profit target. They don't care per contract. They don't care if they buy $10 or they buy a $1 contract. Their target is $200. So all these ways of determining the target are not correct. our own profit objective, 40% or some kind of a dollar amount. In other words, we are asking from the market. So think about it, when we put the objective of 40% target or a dollar target, we are asking the market to give us this money, whereas the market don't care. So market will give us what the market will give us, what is there. So we have to constantly evaluate our trading to figure it out whether we will be in profit or not. Sometime when we start the trade in, so I'm referring option. So we start the trade. When we put on the trade, we see the chart, we find the entry, we find the exits. So everything look good. We select the option. So we know we select the option. We do our best to find the right strike, month, the based on the momentum, how fast the stock is expected to move, what else is going on, and so many things. And then we say, okay, this is the target, let's say based on dollar amount or percentage or the chart. But then the stock starts to do its thing, and then it stops. Instead of going up, we bought the call, instead of going up, it gaps down, and then it stays there. So it stays there, like teasing us, and then time decay is kicking in. Our option, it's not technically it's not out. We're still holding it because we see it gap down to a level where it's supposed to rise. But then the time decay starts to kick in, and the target may hit, but the someday, but the profit is not there, or the profit is reduced. So all this we need to manage. So it's hard to constantly evaluate what is going on with the delta of the option, what is going on with the theta of the option, what is gamma doing. So all these variables, what else is going on, whether the stock is creating some kind of resistance. Now it gapped down and it looks like it bottomed, but it's not moving. It has some resistance. So the buyers are not there. They won't come. There's no this. It's not like stock gap down and suddenly the stock just starts moving up. Buyers are there. It happens, but we have to wait. We have to wait for all the buyers to come in and start buying. So for instance, Intel. So it gapped down. Uh, and it's just hanging there. So for if we believe that the Intel is going up after gapping down the other day, then we need to buy something to give some time. So now our strategy is it's the same gap down bottom, but now we have to give some time because gap down and it doesn't reverse right away. So if we believe that this gap down is the lowest point, but it will take time. So if you buy the shares, if you buy the shares, the share doesn't have any time value, not a time decay like option. So option, we are renting it. So options are made for speculation and hedging. So it's not, there's no time decay except the opportunity cost. We could put that money into some other trade for a fast turnaround if we find the opportunity. Otherwise, our investment is there. So for option trading, we need to constantly evaluate based on the target what will be the option price. So there's one way, simple method of evaluating the option target could be that, okay, this is the target, this is the entry price. Entry price is 100, target is 104, so $4 difference. The simplest method is to take the delta at that time. We know for delta tells us for each $1 move how much the option will move, and delta is also constantly changing. So as the stock moves up and down, the delta is changing, but we get some kind of an estimate. This will be the move in the option from the entry price to the target by taking into taking help with the delta. So this is the simplest. Other way of calculating the option target is to plug in the option formula and plug in all the numbers they ask you, the strike price, the current price, the target, interest rate and dividend, etc., and then it will tell you the option estimated option price. So you can do that and figure it out at the target what is the option price. Now there is another way, selling your options, which is one way is selling the option when the stock is hitting the target. So it doesn't matter or that resistance level. If you're trading calls, it doesn't matter what the option is priced at, because we are trading stock. We are using option, we're trading option, but we are reading the charts of a stock. We are not reading the chart of option. So maybe there is a way of reading the option, so people do read the chart of option, but I don't. So we are trading stock. So when we are looking at the chart, we are reading the chart of the stock. So the support and resistances and all the thing which the stock is doing in its landscape, option is not doing. Option is just following the stock move. So one way is to sell our option when the target hit. It doesn't matter if it hits tomorrow or it hit 20 days from now. If it hits tomorrow, so the option will gain a lot, because we didn't lose any time decay and the stock just hit the target momentum. And we make, from the percentage point of view, we make a higher amount. So if we buy, let's say we buy IQ at 645 for 60 cents, we went long, let's say, on IQ. And if the target hit tomorrow 750, then a dollar move in IQ, which is a big percentage gain in a smaller price. So in a smaller price option, the dollar move equates to maybe 2, 3, 400% gains. So from 645 to 750, whatever is the dollar, the 30% move in the stock. So 30% move in the stock translates to 400, 500%, whatever is the gain in the option. So think about that. 300, 400% gain in the option. And if it happens very next day, it will reduce to maybe 250% gain if it after hits 3 days, maybe 200 after 4 days. So same option. So we are trading IQ, a short, small price stock. So why we would put 20% profit target, or a 30% profit target on such a small price stock? Because this is a small cap, 60-cent option. Tomorrow it goes down a dollar or so. The option, 60 cents option, will turn into a 2 cents option, and the bid, there won't be any bid. So total wipeout in that position. So the trader make a mistake of, they don't realize that they're buying 60-cent option, so there shouldn't be any stop, or even the higher price option. So we need to set our option based, a sell order based on the stock target. If the stock target is 750 or 8, like Carvana. So we bought Carvana, and today Carvana moved. We closed the trade. We closed the trade a little early than supposed to, but it moved. So same phenomena in IQ. When the stock is hitting the target, it could be 304%. So we cannot put a 40% estimated target based on the option. So if we buy at 60 cents and we say, okay, 60 cents, 20% profit, maybe I sell it at 80 cents. So that's not good. It's already at 90 cents. So we can set our option order based on the stock target. So let's say IQ at 8. So the way it works is, we tell the system, we tell our trading platform or broker that, hey broker, sell my IQ contracts which I'm holding, let's say March 750. I bought it at 60 cents. You sell it when IQ hits $8. So now that your order is sitting there. So as soon as the condition hit, the IQ hits $8, equal or greater than, your option order becomes the market order. So it translates into market order, and your contract gets sold at the last price. So here is a catch. The last price could be not, sometimes the last price is not a good price. It could be something else. So we need to set the conditional order for the liquid options. So there are many reasons why we put the conditional order and why we don't put. So we put the conditional order when the options are liquid, when the stocks are liquid, when the bid is tight. So your market order gets executed at the last price. And so that's a mechanic. So conditional order eliminate greed and enforce discipline. So if we know the target of IQ is 8, so we what happens a lot of time when the stock is hitting some kind of target, the greed sets in. So our emotion, excitement. So main emotion is excitement, and then excitement creates various forms of other sub emotion. So excitement can create greed, fear, etc., anger, and whatnot. So one of the emotions, sub-emotion of excitement is greed. So we get excited. We see some profits tomorrow or the day after tomorrow. We see a big profit, and we forget that we did some homework and we had decided to sell at 8, and we don't sell. So it could be a major target. It could be a major resistance. You figure it out, and the stock is just moving fast, 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 and it hit 8, and then you at that time. First of all, you have to sell what if you are watching it, you sell your option right at that limit order or market order, whatever it is. Sometimes, majority of time, we cancel our sell order right when it's accelerating and hitting some kind of target. So if you have that problem of canceling your sell orders, or maybe you have multiple positions in various symbols, and you don't have time to monitor during the day. So all that requires you to put the conditional order. So we put the conditional order to eliminate greed and to enforce discipline. So tomorrow, if let's say if any other stock, ABC, and it's not doing anything, and you are waiting for it to hit some target, so and you're not constantly watching that symbol also. So you can put the conditional order that, let's say Apple, if Apple hit 150, I bought it at 130. When Apple hit 150, please sell my contract. So when Apple hit 150, your contract will be liquidated at whatever is the market price at that time. Provided, you need to know the spread is narrow and there's a liquidity. So I give you example on Apple. Let's say you're bullish on Apple and the current price is 150. The target you determine is 155. So you bought July 150 calls. So let's say you bought July 150 call is the month of June. You paid $3 for it. So you paid $3. Now you have many options how you will sell. You will simply sell saying, okay, I'll be happy when I get 40% profit. So 40% profit on $3 will give you a $4.20 bid. So you said that $4.20 bid, get good till cancel, and you let the Apple hit 420. So whatever this Apple is doing, it hit 420, option hit, and then you are out. So that's one way of selling your option. But mm, this like I described, this has some drawback. So it has a drawback. 40% may not be there. So for 40% profit objective, what about 40% profit objective? If let's say Apple hits tomorrow, you bought at 150, it went to 155 immediately. So it won't be 40%, it may be 100%. $3 option can become $6. So you lose, you lost that thing. What if you put the 40% and it took 15 days gone by, and your $3 option is trading at $2, let's say. 2 weeks gone by, your $3 option become $2 option. So now you still have that 40% profit objective. So your $2 option or $2.10, let's say $2.10. In order for $2.10 option to go to $4.20, it needs to go 100%. So you're looking for 100% gain from the low point. So 40% doesn't make sense. You need to reduce maybe it makes sense, but you're still hoping it will go. Now, it needs to go higher than 155. If based on 155, your profit, you calculated that, okay, when Apple hit 155, my profit will be, 40% in the option. But now the Apple, instead of going to 155, is trading at 143. And it just lingering 143, 144. So time is killing your option. So even if it hits 155, your option will not be at 420. So you need to constantly recalculate saying, oh no, Apple didn't do what I expect. It's just sitting there playing possum, and the time decay is killing in. Look at the delta. Delta is going down. Look at the theta. Theta is this. My option will be not 40. I will not be making 40. I'll be lucky if I get out at break even. So based on the new calculation you did, it's coming out to $2.90. So you should be happy to sell at $2.90 and get out at 10 cents loss, because the original plan did not work. So your profit objective failed. If 155 target is still valid, so you should be selling at 155. It doesn't matter if the option is trading at $3.10 or 3.50 or 4.10, 4, whatever it is, because you are trading the Apple stock. So you are not flexible if you just put your profit objective of 40%. You're rigid, you're stubborn. So you're asking the market to give you the 40% profit, whereas the profit is not there. So this has a lot of drawback, and traders just stubborn, and they want profit. So if you have a history of your trades and your average profit is 40%, 50%, maybe, and then, so history says 40, 50% of the my profit based on this pattern. I trade option. This kind of a market situation, I make in on average, I make 40%. So I'm better off selling my contracts at 40%. If that is your data telling you, maybe you can set 40%. So constantly need to revise. So that's one way, setting the profit objective. Another way is to setting the dollar amount. So you say, okay, I won't just make dollar 100 per contract. So I bought $3 contract. When it goes to $4, I sell at $4. So it doesn't matter. People, traders make mistake. They don't think, they apply the same formula. They buy the $10 option and they still sell at $11, which is, and they buy $3 option, they still sell at $4. So they have a fixed dollar amount. They just increase the number of contracts. So so maybe it works, maybe not. I don't think it should. It works proper. It's not the proper trading. The other way of trading is when stock hits the target. Sell Apple call when Apple reaches 155. So you are constantly monitoring the target Apple. So whatever is the option price. So if the $3 option is trading at 6, you sell at 6, because let's say you bought Apple today at 150 and tomorrow it went to 155. So $3 option becomes $6, not $4.20. So when 155 hits, you are getting out. This 155 target may never hit, or if it hits, it may hit in 10 days or 12 days. So whatever is the option price at that target, then you need to sell your option. So there's another way of selling. Now, another way of selling your option is calculating option price based on the stock target. So you can plug in your numbers in the option calculator formula and say, okay, this is the current price, this is the strike price, the time to expiration is this, and all the other uh, the formula will ask you the question about the interest rate and if it's pays dividend or not. So you put your numbers in that formula, and then it says, okay, based on 155 target, your Apple option will be trading at estimated price of $5. So that is a $5 option. Maybe it's ask price. So then you look at the spread, and the spread is, let's say, 20 cents. So you say, okay, if the formula is telling me when Apple hits 155, my option will be $5, and the bid, the spread is 20 cents, so 480. So I will set the order at $4.80. So, and as $4.80, and as the trade is progressing, you're monitoring your stock and you're monitoring your option price, and then you can fine tune your option price estimate. When, let's say, stock is trading at 154 and 70, so stock is trading at 154.70 and the bid is 450, then you say, okay, when by the time it hits 155, the bid will go to 490. I estimate 490. So you set your order to 490 and you sell it. So that's the fine tuning. So we need to do the fine tuning of our sell order in options. Or the best way is, if you're devoted to trading, you see you're monitoring it, and as soon as the stock hits the 155 target, you get the alert at 155, and at that time so exit protocol triggers 155. Now you go and sell your option. So that's another way of selling it. I think that's the correct way, that you monitor the stock hitting the target, and then decide. And you already know. So some of the trade may not go right away to the target, and they lose money. So they are losing money. So if that's the ultimate target for Apple, let's say 155, that's the ultimate target. So when the ultimate target, you know that this is the highest resistance. So now it doesn't matter if it's trading at $5 or 490 or $4 or 290. We need to sell. So uh, we cannot be rigid, saying that no, I just want to make some money. Sometimes even if a 10-cent loss we have, and I set the sell order, I say please close this trade. People, if there's I say take 10 cents loss or break even, and I get the response. I'm not at break even. I'm still losing 10 cents. Do you want me to close it? Close this trade? I'm losing 10 cents. Do you want me to close it? Not at break even. So yes, so please close, take that 10-cent loss. So in other words, we need to watch, and there may be many other things going on. What if there is a long weekend and it's a Friday, holiday coming, some news coming, so many things going on. The stock is hitting the target, but the option is not there. Even if you can revise your target to the upside, let's say you're not in profit and 155 target hit, and you say, okay, I'm not in profit, I'm just making a 10, let's say 10% gain. So do I see a higher target? So maybe 155 was the first target, and then there is another higher target, 159, and then there's a third target at 161. So you say, okay, time decay, kill me, option is not, I'm not making money on this one. My $3 option is just at 310, and the stock has hit the first target. Now what to do? So you say, okay, I can wait for to sell at higher target, because you don't see the resistance there. So you figure it out. If I sell at the higher target, then I'll be able to make $4.20. But I'm sure that 159 will most likely hit, because it has crossed 155. So then you change your order. Then you say, okay, my Apple target is 159, and based on that, I think I will be able to make 40%. But if 155 is the ultimate resistance, then take whatever you take and sell it and close your position. So there are various ways. We need to constantly revise. We need to constantly look at uh, like we need to see, okay, if the stock moves $2, how much the option will gain and how much we will lose due to time decay. So there needs to be constant evaluation based on the delta, based on what's going on, based on the theta. So many variables going on. Give and take. How much I will give back and how much I will gain, but if the stock moves this much, these many points. Okay, so flaws, there are many flaws. So profit objective of 40% may not hit. So if we are rigid 40% profit, it may not hit, or it can go to 300. If it's a small cap, it can go to 400, 500% gain. You bought a 20-cent option and it's going to $1, so maybe 500% gain. So why you are putting your 40% objective? So you have to be careful what you're trading. So depending on the stock, depending on the movement, depending on the volume, depending on the news, and what else is going on there. So that's 40% may not be right. Calculation of option price based on target price cannot be accurate. So sometimes the formula is giving you, and is things are changing. The volatility is changing. All the other things are changing in the formula, and you may calculate inaccurate option price. So then it's not 100% reliable. It's just estimate. So it's just an estimate. And third one, selling option when the stock reaches target requires monitoring and discipline. So this one is you need to be present. So when you have you bought at $3 and now you want to sell Apple calls at 155. So you're watching your stock chart. So this requires discipline. When the stock is hitting 155, you really need to sell. Otherwise, you need to if you're not disciplined and you're changing your sell orders right when the stock is hitting, you may be missing out. Or there's another. So from excitement also comes regret. So excitement is the main emotion, and then the sub-emotion, the regret and remorse set in when we see the target hitting and we cancel our sell order and we don't sell it, and then we become like uh, we throw tantrums and we throw mouths because I knew it, that it will hit the target and it will pull back. I knew it, and they are out there, etc., to get my money. So we just harming ourselves. So all that you can eliminate through conditional order if you're not disciplined. So if you're not disciplined, you can sell based on the conditional order. So removing greed, enforce discipline, like a boot camp we have a billboard here, is a dog boot camp, bring your dog here. So like a summer camp for the kids. So maybe you need to be going into some kind of a boot camp. So to remove your greed and discipline. So you say, okay, I always mess up. I need to go through this kind of a discipline. So free up. And then another one is freeing up your time to trade other stuff. So if you set your sell orders based on conditional orders, you can do other things like watching other trades. So at least you have set your sell order based on the stock, and you can always cancel, but it's there, and you're trying to find other candidates, because watching your open position, like 20 open position, and then um, so it's like bullets are flying. It's like in the morning it becomes like a battle. It's like a war. The bullets are flying, the market is going up and down, and the market is green. Oh no, market is not green, it's red. It came down. Oh no, this was moving so fast, I missed that one. I was making 2,000, now I'm only $1,500. What to do? This trade, I put it on my watch list, and I knew it will go up tomorrow, and then I missed it. So all that thing going on is not easy. So imagine me, I'm doing all that, plus I'm sending emails. So I do all that. So in order to free up some time, we can put some conditional order to sell. So I'll explain to you the mechanics, and then you can look in your broker's platform if you don't know, or call your broker, or chat with the broker. Don't ask me, please, how to set the conditional order in your platform. Like today, I received email. Can you guide me in my trading platform how to set the buy order? That's the email I received. Can you please guide me in my brokerage platform how to set the buy order? Uh, so I said, please call your broker. So number one, conditional order puts money in our account automatically. So there's some advantages of conditional order. So when the stock hits 155, your order executed at market price, and it's out. This conditional order is very effective when the market is either very bullish or bearish, and you have multiple positions, and you don't multiple position. And maybe it's also good when you have multiple targets. So if you have 10 contracts, you can set 3 contracts when Apple hits 155, 3 when Apple hit 159, and the other 4 when Apple hit 162. So you can stack your sell orders. So stack your sell orders on a various conditions. It's Apple hitting 155, 159, 162. So conditional order puts money in your account automatically. Conditional order allows us to take our dog for a walk. So people like to take their dog for a walk. So conditional order allow us to take our dog for a walk. So you can go for a walk. You can make coffee. So do other things. Pick up your phone. Maybe you're running a business. Maybe you're working somewhere. So something like that. Conditional order enforces discipline. So conditional order enforces discipline. So all that I talked to you uh, does that. Conditional order removes greed. So if you are greedy and you cancel your sell order, if you're greedy and you cancel your sell order right at the time when the target is hitting, um, do that. Conditional order is set and forget strategy. So conditional order is if you have multiple 20 position and you cannot watch all, at least you have set your sell order in advance based on the condition, and you can change it. You can change it anytime. And I will explain there are other conditions, not just a stock target. You can have a you can sell Apple contracts when Baba hits 100. So you can do that. Or Facebook hit 500. Sell my Apple contract when Facebook hit 500. So you can do all that. So sell my Apple calls when Nasdaq hits this target. Sell my Apple calls when S&P hits this target. So your condition is based on some other symbols. Sell my Apple by market close. So you contact your broker and say, okay, what conditions I can set to sell my Apple contracts. So they will tell you that these are the conditions you can set. It doesn't have to be Apple. So uh, explore your trading platform. So how conditional order works for calls? It's like this. You telling your broker. So this is when you're writing a program, if you're in a technology and you're a programmer, so I used to be, not anymore, but I write my things. I give to my programmer to do certain things. So I don't write a code. I just tell in simple English. So it's like a simple English, and then it gets translated. So this is a simple English which you are setting up in your brokerage platform. So brokers know what to do. So you're telling your broker, hey broker, sell my Apple call contract at market price when Apple stock price is equal to or greater than 155. So if tomorrow Apple gaps up to 159, your order will become a market order. And at that time, so there is a drawback. So you may get a wrong fill because of the market price. So this is a drawback. You cannot set it as a limit order. So whatever is the option price trading at that time. So sell my Apple call contract at market price when Apple stock price is equal to or greater than 155. So so equal to or greater. So if it's trading at let's say today it closed at 154 and tomorrow it gaps up to 156, your Apple sell contract will be sold at whatever is the market price, and the market price is the last price. So just make sure that so this is good if you're not in front of the computer. Who knows if it gaps up to 156 and close at 153, so then you miss out. So this goes in your favor. Sometimes it doesn't go in your favor because the market gaps up, and then so it's like any other order. Market can gap up and then you get filled and you regret. So it's and it's just like any other regret. So some points to consider: order is set at market, not at limit. Your order is set at market, not at limit. So this is a drawback. You cannot set a limit order. Greater than or equal to condition is set for calls. So greater than or equal to condition is set for calls. So if you trading calls in Apple, you bought at 150, you say, okay, when Apple hits 155 and above, um, sell my Apple contracts at market. And if you reverse it for puts, so if you bought puts in Apple, Apple is trading at 150 and your target is 140. So then you will say, sell my Apple puts when Apple is trading at 140 or less. So in case it gaps down, it's still valid. So less than or equal to condition is set for puts. And the most important thing is when you're testing it. So I remember testing it with one contract, and maybe you need to test it. So if you have 10 contract, you test it with one contract, and maybe you test it in a simulation account because you may make a boo-boo of your trade. Um, let's say, uh, like, the sign of equal and then equal. So maybe you don't even know what is the sign of a equal and a greater than equal and greater than equal. So if you don't know the sign of the greater than or equal and greater than, you may choose the sign of equal and less than. So just make sure you setting it properly. So in order to test properly, do it with one contract. First step is to do it in the simulation account. The second step is to do with one contract in the real account. So what you can do if you're testing it, let's say, so I would do like this, I would test it in simulation account. Then when I'm testing it in the real account, I would not set this order in advance. I would set this order when Apple, let's say I'm testing it on Apple, I would set it when Apple is, let's say my target, I want to set sell order at 155. When Apple is 154.90, then I set it, I know that, okay, 10 cents left. And in a 10 cents move, my Apple should be sold, one contract, or in simulation. So you're testing it with some price, which is very close for you. You're not waiting forever to test. To do that testing, and then to set one contract, and then when you are comfortable, then you can set with the other contract. So do that. So make sure you test it. You don't want to just willy-nilly sell all your contracts at whatever price and then you regret. So, so I explained to you about Apple calls, how to set the Apple. Now I'm explaining to you the bearish scenario. So let's say you're bearish on Apple. You think Apple will go down. The current price is 150. And you say, okay, the target price is 145. You bought July 150 put and you paid $3. So you bought July 150 put, you paid $3. Now you will sell your broker. So in plain English, you're telling your broker, let's say you pick up your phone and say, hey, broker, sell my Apple put contract at market price when Apple's stock price is equal to or less than 45. So broker will say, okay, Noshi, I will sell all your puts when Apple hits 145 or below. Got it? And then you put down the phone, and when Apple hits 145, 144, whatever, gap down, etc., is all sold. So same plain English is translated into brokerage platform and you set your conditional order. So it is less than or equal to um, setting. Now the back to, so our brain works fast and slow. Sometimes we work so we don't think, we don't pay attention what is being asked, and we think so fast and we make a mistake. So when we are setting the conditional order, we end up, we just, or when the stock is hitting the target, we just get emotional and we do stupid things and whatnot. So that's the way the brain is. So we need to calm our brain down and think properly. So this question, a bat and ball cost $1.10. The bat costs $1 more than the ball. How much the ball costs? People answer 10 cents. It looks like it's 10 cents. So because we think fast, so 10 cents. The correct answer is 5 cents. So the correct answer is 5 cents, not 10 cents. So the question is, a bat and ball cost $1.10. The bat costs $1 more than the ball. How much does the ball cost? The ball costs 5 cents. So we can put it in Excel worksheet. Bat cost this, don't know. Ball and bat cost this, we know. And then we figure it out, unknown. So we're solving the equation for unknown. The unknown answer is 5 cents. So the question, the answer, correct answer, when we think it properly, is the 5 cents, not 10 cents. So yeah, oh my goodness, people answered 5 cents. Jeffrey said correctly. SR said, oh, good. So I guess you did good job in, in math when you were little. So somebody trained you. Can sell by number of days in trade. Okay, so this is a very good question, Tami SV, Tami Risa. So I don't know if you can file, but maybe there is a condition in your brokerage platform that if the trade is open for 10 days, let's say, then sell whatever is the price. So this is another way of discipline. So disciplining, I watch the number of days. So one of the variables in the trade is how many days it has gone by and I'm still holding that trade. So my objective then become to figure it out, how to get out by either minimizing the loss or break even, or don't care about the profit anymore. The objective is just to get out based on the number of days in the trade. So that can be one variable. The days in trade, how many? So I have the answer to all my trades. I know how many days in trade. Another answer you need to ask, a question you need to ask. So we need to ask a lot of questions. when we are trading and figure it out the answer. And the answer is there. It's just that we are lazy in not figuring it out the answer, or we're not capable of figuring out the answer. It takes time. So either we are lazy or we are not persistent. So we are not persistent. So one other variable is how many days left in the expiry. So if the expiry is 28 days or less, or 21 days or less, then we are the theta, we are paying the time decay. So the time decay is kicking us. So then we have to evaluate, okay, every day we are losing this much in option. So how much, based on the delta, how much the stock needs to move to compensate, based on the current delta and the gamma, how much the stock needs to move to compensate the theta, which is the time decay. So there has to be some balance. So if you think, okay, the stock moves $1 based on the delta, and based on the theta, I will be balanced. So at that time, you need to do the calculation. So time, number of days in the trade, you need to know. Days to expiry, you need to know. The third variable you need to know is how many days to the earning. Maybe the earning is uh, uh, maybe the earning is 3 days left. So if the earning is 3 days, we need to know. So let's say the stock is moving up, going up and up and up, and finally it's reaching some climax, and we know that the stock will move few more points left. But then we say, okay, you know what? The earning is coming up. So now we are in a tight zone. The 3 day left to earning. We have this much profit. What if the stock goes down tomorrow? We're not going to sell it because we had this much gain. Now we don't have gain. Then we will give excuse. So we are good in we are excellent in giving excuses. So we will think like this. Okay, I had $1,000 profit, 3 days in earning. Okay, let's wait. And then tomorrow the stock goes down. Now I have only $800 profit. Now how can I sell at $800 profit? I still have 2 days left. I can still sell it, and who knows, the earning will make it go up. They beat the earning all the time, so this time is no different. So 2 days left, and then the stock goes down again. So now is the $700 profit. Now we are still gambling on that one day. So that one day it can go and go to the moon, or if it goes to $400 gain, then we say, okay, only $4, 400. No, I'm not going to sell this. So we expect the earning to come in our way, whether it's a call or put, and then $400 become $0, and then we lose that trade. So we have to keep an eye on, figure it out. Okay, if the earning comes, and um, the trade goes the other way, then how many days left in expiry? Will we have time to recover? How many days we are in the trade? If the stock falls in earning, let's say we are in a call position, where it can fall. So where is the demand zone? Where is the support? Where if it falls, it will fall there, and I will be able to manage it and get out. So all that needs to be taken care of. Days in the trade, days to expiry, how many days left in earning, and where is the support, where is the resistance, what is the delta, what is the theta. So all that we need to constantly evaluate, and whether we have a potential in the trade or not. So maybe there is no potential left in the trade because of the option. So options are tricky. So uh, no, it says if I miss an alert and wait later 2 hour by the time the price move or strike price increase by say 20%, the way to get a suggestion. So, uh, so the question is, if I miss the trade, what happened? No, it always is not like, okay, sometimes it goes through the moon. It just keep going, and then you miss it. The 60 cents option is trading at $1. So you will not be buying a 60 cents option at $1. 60-cent option, you may pay 65 cents. If you bought a $4 off contract, maybe you pay $4.20. Few contract, and then buy other at $3 at 350. So you may buy some because you think you missed the boat. So It's not a bad trading when you are thinking that you will miss the boat, that you initiate your trade to get in the trade, but lower the exposure, so you don't go all in that trade when you miss the boat. Let's say you think you miss the boat, you because sometimes the breakout and the momentum is such that the stock doesn't come back to the price where you intend to buy. So at least you have some position. So buy some. If you intend to buy 10 contract, maybe you buy two, but see where how much extra you're paying. So the rule is don't pay more than 10%. Don't pay more than 10%. 50% making. Okay, thank you, Rajesh. So time decay, you can Google. I can create another webinar and explain the time decay. So time decay is very important. We need to monitor. So I can create another coaching session. I have hundreds of topics to teach. So I'm just preparing it as I go by, beside doing other things. So I'll create a session for time decay and explain to you. So I monitor time decay, I monitor delta changes. So I monitor the change in the delta, how much, and I constantly evaluate what would be the option price at this target. And I'm constantly adjusting it. If I have to adjust and it's meaningful adjustment, then I send the adjustment to the members. So they are constantly aware of the new targets. So I'm doing that. I have also started sending estimated option price. So I was sending only the targets, the stock targets. Now I started sending option targets also, but option targets are constantly being washed. So we need to wash the option. So if I send the alert at $3 and send the alert to sell at 420, so that 420 is valid or not. So this needs to be watched. Whereas if I send the alert to sell Apple at 155, entry at 150, that $5 watch is not that closely monitored because it's there. I know it's there. I'm reading the chart. But the option calculation is requires a lot of time and attention. To constantly need to monitor and adjust, and it's not accurate. I'll prepare and no, I don't do any gamma. I said I don't do scalping. So the lower the time frame, the higher the chance. The lower the time frame, the higher the chance that I go to the poorhouse. So I don't put. I don't want to go to the poorhouse by doing scalping and on creating headache. I have a lot of things to do during market. I can't do scalping. If I'm doing scalping, I'm not talking to anyone. I'm just I become a monk. So I cannot be a monk, so I cannot be a scalper. Same concept. You can set your sell order at loss. So let's say you bought Apple at 141 when Apple was trading at 150. So you can set the sell order that when sell my Apple contract when Apple goes to 145 or below. So that is your stop. So if you want to do that, you can do that. So you say, okay, Apple is, sell my Apple contract when Apple goes to set my stop limit order, set when Apple goes to 145. So you can do that with your broker, but you do the testing on your simulation account and set the order close by, like the price, whatever is the price, you set the price close by, so you can see the result right away. All right. So I will see you next time, and thank you for coming. Bye.